Hello, tradeologists. Hey, in this part of the big picture, we're going to talk about a little bit further about technical analysis and exactly how you can use it in order to help determine where prices might go. In other words, we're not trying to predict where prices are going to go. All we're trying to do is get an idea of the probability of prices moving in a certain direction. Does it mean that they're always going to move in the direction that of the highest probability? No. Many times prices will act contrary to what logic would dictate. And not only that, but they're also, when they do act completely different than the probability would state. In other words, if we believe there's a high probability that the market would move up, and all of a sudden it reverses and goes down instead, that is a significant event. Also, we can use different tools in order to determine where prices might go or might not go. Again, with the idea of determining the probability of the prices moving in that direction. In no way, and there's just no way that we're going to be able to predict future prices. It just can't happen with any degree of certainty, because there's so many different factors in the market that would determine where that price actually will go when it happens. The only thing we can do, again, is, and I'm going to emphasize this as much as I possibly can, is that we only look at the probabilities of price moving in a certain direction. So we have a couple different tools that we utilize in order to make that determination, and I've already told you about some of them, which are support and resistance points. The important thing to remember about support and resistance points are, if it's hit a point and it bounced off of it dramatically, that is a significant either support or resistance point. Okay, I've got the weekly chart of the Dow Jones Industrial Average here, and you can see the little, let me go to a daily chart here, because I do most of my analysis on the daily charts. The little red circles here that you see are points at which the market had moved to and then bounced dramatically off of. And those points become significant the next time that the prices come to that level. Sometimes more than others. For example, on this particular point, it did come back up here, but it didn't drop significantly. It actually rallied through to the other side. This point has become significant here a number of times over the future of the price movement. So in other words, this happened back in early December, but that particular price support level became resistance here, 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 and here again. So it turned out to be a rather significant price level. This was also a very significant price level. Prices bounced off of this as support. After it broke through, it eventually came back up again twice to this very same price level, and prices dropped dramatically from there. So that turned out to be a significant price level. The important thing to remember is that prices do become more interesting, more supportive, or more resistant at certain prices. They, for some reason, hit certain points in the market and then bounce off of those. If you can identify those ahead of time, you'll have a lot easier time determining the probability of future market direction. So how do I mean, if I was going into the stock market, how do I really kind of determine the general trend of the market? Well, first of all, I look at a couple of different things. I look to find out whether or not the index or the stock that I'm looking at is making higher highs and lower lows. If it is, then I've determined that the market is in an uptrend. I have to have at least 2 higher highs and at least 2 lower lows before determining that in fact the market is in an uptrend. For example, we would not have had a higher low if it weren't for this low. So we have one higher low here, and then we have a high, but I don't know if that's a higher high yet because I only have one of those. But I do have two higher lows. So now I'm looking for a higher high. After the market had rallied up to this point, I do have my higher high. And I didn't, let's see, I didn't put my oval on that because it's not a resistance point. It's actually just a higher high. So I've got two higher lows, and I've got two higher highs. At that point, it's highly probable that we are in an uptrend. At that point, I'm looking to purchase the pullback from this high, from the second higher high, and that would be this point right here. At this point, I would go long the market, and you can see it did very well actually the very next day. Another thing that I always take a look at before I take any positions in the market whatsoever is something called the VIX. I will go to the VIX in a second, but I just want to point out a couple other things about determining the probability of future price trends. Generally, in an uptrending market, prices will advance and then pull back sharply. They will advance and they will pull back, either sharply or slightly. And what these are called flags. Let me just draw a little bit of a trend line around this so you can see it a little bit better. These are probably the most reliable continuation pattern in the market. This type of pattern. It's a pattern in which prices advance and then slowly begin to decline. Now in this case, the pattern failed because it declined but then shot right back up again. But still, it's still considered a flag. It's a slow deterioration over a number of days away from the high that was established prior to this pattern. And in this case, I think a lot of people probably would have been faked out by the fact that they saw this flag pattern, which is a common technical analysis flag, and a pattern that's commonly used by technical analysts, and they saw it break down here, and they probably would have thought at this point that we were entering a new downward phase of the market, when in reality we have a higher low that was established between this low and this low. And in any time that you have a higher low, you could establish another position in this area. Technically, you wouldn't want to establish a position unless it broke the high of this bar here. Anytime you broke through the high of this bar, then you could go long on the position, and that would have worked out very well. But this flag was actually an indication that the market would continue higher, because this pattern of slowly eroding prices going down in a slow stair-step manner is actually a fairly common pattern that most people recognize but don't know how to trade. For example, if this pattern had resulted in an upside move, breaking through either this high or this line that was established here as a downtrend line. We could probably do a better job of connecting the dots here. And if it had broken through there, they would have taken this as a signal to go long on this particular index. But as it was, it broke down through here instead. Hit a support line and bounce back up again to continue its uptrend. We can see this flag pattern actually in a couple of different places. We see it here. We see it here. we see it here in a rather sharp way. But we also, and we see it here. This one failed, however, when it failed to break through this resistance point, although prices did go back up from there. But the important thing to remember is that prices will have this slow erosion after making significant progress to the upside. There's a slow erosion of prices over time that look fairly straight down, but in fact are continuation patterns. Opposite of that are patterns in which the market will start to decline. If we go back over some of these patterns in which large price drops have taken place, you can see that instead of, let me just move this out of the way for a second here. You can see that instead of having a controlled little decline like this one here in a straightforward fashion, this happened to be somewhat rounded at the top. Let's take another example. Here's the second pattern in which prices declined sharply. You have this rather rounded top in which prices shot up. They did form a slight little flag pattern right in here to indicate that prices would continue higher, and they did. However, at that point, it created a larger rounding process. This rounding process indicates that market prices will generally drop. So you have this higher bar, you have a down day, you have another down day, then you have an up day in here, and then another day in which the prices almost meet each other. But this rounding of this top is considered a bearish pattern. Here's another rounding top. It's very difficult to see if you've never seen this type of pattern before. But once you recognize it, you'll begin to see it in a lot of different stocks. This kind of a semi-round pattern. Here it is again. Slightly higher highs and then another higher high that kind of rounds off with this one right here. A slightly rounded pattern. Here's a very good example of this rounded pattern here. Higher, higher, flat, flat. They're all very flat at one particular point. It's an extreme rounded pattern. Here's another one where it's very rounded as it continues to decrease in price. So when prices are ready to decline, generally you see this kind of a rounded pattern at the top of a particular market or index. When prices are going to continue, they form flags. Here's a very good example of a flag. These are straight down, pretty much straight down patterns. There's no rounding in here. I mean, it doesn't have to be exact. This is just the general trend of the price after it has moved up. It has this downward slope to it. It's not rounded. There's a downward slope. Now look what happens when a price continues, when you have a continuation pattern on the downside. Here we have a rounded top. And how would we know whether or not this trend is going to continue? Well, we have a flag. See, the flag not only works for markets that are going up, as in these cases, but it also works for markets that are moving down, because a flag pattern will develop in which prices slowly begin to rise after a downward pattern. And these prices will rise and then round off again in order to continue the decline. These patterns are so prevalent in the market, they do take some training in order to try to see them. It's very, very difficult, but once you begin to recognize these patterns, you can begin to at least have a good idea of how well and what the probability is that the market will either fall or continue its uptrend if it's in an uptrend, or continue to fall if it's in a downtrend. So here's the rounded pattern, here's a rounded pattern, here's a rounded pattern. This is only 3 bars long, but this one was a little bit better actually because it had 3 bars in it. It doesn't matter how many bars are in the pattern. When you get this rounding type of effect, rather than something that goes like this, straight down, this straight down pattern will indicate that prices will go higher. This rounding pattern will indicate that prices will probably go lower. And then in between these, you have flags. In fact, here's another one right here. This is a perfect flag. Isn't it? I mean, look at this. Prices just, I mean, they don't have a real bottom. There's a slight little bottom here, but what they do is they continue to move up in a very slow, methodical fashion from where they were. And it forms, you know, this little flag pattern. Once you get used to looking for these flag patterns, and you get used to them, it will help you tremendously in your ability to find high probability trades. So let's say you saw this rounded top here. Prices came down. How do you know that it's not a good time to buy and go long, hoping that prices will continue the uptrend that it had already established? Well, one clue is the way that prices reacted after falling. They gradually moved up, forming a flag pattern. At that point, you would have known that this was a continuation pattern and gone short because it's establishing a continuation pattern of this downward trend that was established here. Let's take a look at current market conditions. Currently, we have 2 tops that formed a very, very broad rounded pattern here. In addition, this is slight. Each pattern, each point of its own was a rounded pattern. Prices declined here, but then formed a. Let's do this. And then formed a flag. Right here. Now, what is our definition of a flag? A flag is a gradual increasing of prices over time after a decline, in this case, a continuation pattern for a further decline in the market. We have a rounded top established with the top of this bar, 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 and the top of this bar. So it's a fairly broad rounded top here. In fact, we could even include this bar here. So we've got 1, 2, 3, 4, 5, 6 bars here that are whose tops are very close to a very rounded, nice rounded pattern. Then prices declined and they formed a flag, which is a gradual increase of prices over time. Not particularly strong increase in prices, but just a gradual increase in prices after this large decline here. That gave us a clue, not only this rounded top, but this flag pattern gave us a clue that prices would probably continue to go to the downside. And they did. Again, we come into a pattern in which there is a gradual and steady increase in prices, forming another flag. Flags generally are a continuation pattern. And they don't have to be exactly at the highs of these bars or the lows of these bars. What you're trying to do is pick up the pattern, to understand the pattern. So after this pattern was established that there was a gradual increase in prices, you would have had an extremely high probability that prices would continue this downtrend again. And they did. Today, we had somewhat of a reversal day. In other words, we had an extremely strong up day in which there was high volume and high prices increased dramatically. In fact, the Dow Jones Industrials were up 201 points. Generally, a strong upthrust in prices like this indicates a strong market and perhaps a continuation of an uptrend. Now, we've had an uptrend here since around March 10th. We had an extremely strong up day here, and you can think of these strong up days with huge price movements as something like an energy blast, or fueling your car with premium fuel, really helping the market to blast off. And when we had that day, what we wanted to look for was a gradual decline of prices from that strong uptrend, because when you have a strong price increase like that in any stock or any indice, there are always people who are willing to sell their stocks at the high of that large up day. So over the next couple of days, what we do is we watch the prices very closely to see if a flag pattern will be forming. And in fact, it did. Again, these do not have to be exact. What you're looking for is a general pattern of slowly declining prices over time. And that's exactly what happened. These were a bit wider than usual, but that's to be expected at a market bottom. This is really a market bottom here. And then prices did actually increase, pull back again, form another flag pattern, increase, form a tighter flag pattern, and break through that, but still established a higher low, and then increases in prices came again. Each time a price increase of a day or 2 or 3 days in a row was established, they had a slowly gradual pullback and a slow gradual pullback before prices continued again. Eventually, as you start to develop your eyesight, really your technical eyesight for these types of patterns, you'll be able to pick them up very, very quickly. You'll be able to see flags and patterns. And once you can see these, this is the very, very simplest form of technical analysis that really works. These types of flag patterns are the easiest to recognize forms of continuation patterns in the market. So where we are right now, we have a very strong update today on pretty good volume. So we're going to be hoping here that it will continue to increase in price. However, what we're looking for to establish long positions is a gradual pullback in prices, just like they did here, or they did here, or they did here, or they did here, or they did here. We're looking for those gradual pullback in prices so that we can establish a long position. Let's go back a little bit further and see this in other types of markets. Going back to July of 2007, you can see that we established at that time what was to be a very large uptrend in the market. We had a huge run up in prices here, and we had a flag. Instead of drawing two lines, I'm only going to draw a single line from now on, just to make it a little bit easier. But you can begin to see these flag patterns develop. Once you begin to see a number of these flag patterns, it's a pretty safe idea, as long as you have higher lows, to begin establishing long positions in this area. If that was the type of trading that you wanted to do. You can see that almost all the way up, these flags were established, and once the flag was broken through, the continuation of the uptrend continued. Now this pattern was a little bit different. It was just a sideways pattern. However, it's still considered a flag pattern. And you can see that all of the patterns differ just a little bit. You know, some are extremely gradual like this one, some are sideways like this one, some are pretty deep like this one, some are a little bit deeper like this one here. This one was fairly short and narrow. This one was very much deeper. In fact, it was the beginning of a sign that maybe there was some trouble here in the market because of this rounding top. Although markets do not die very, very soon, there was, because of this rounding top here and the almost the breaking of this lower high here, you could have begun at that time to start to look for signs of deterioration in the market. Here's another rounding top, another rounding top, another rounding top. Rounding tops don't necessarily mean that the market will decline right after a rounding top, but it is a way for us, remember, to determine the probability of a future price movement. If prices had broken below the prior lows of these, and each time it broke below these prior lows, you'd have a more established downtrend in place. But these rounding tops, every time the market moved up a little bit higher, was a warning that perhaps something was happening in the market and that prices would drop dramatically. Again, we established a position here that was that looked like something like a bottom, in which there was a support point here and the market rallied up, and a continuation of prices in which the flag patterns begin to develop again. This was a very short little pattern right here, so they don't all have to be long patterns. Some of them can be extremely short. Here's a short pattern, that's a short pattern. This is a short pattern, and now we're starting to establish rounding tops again. See, in these cases, if you were establishing a rounding top, you would take a look at prices after they increased, and then begin, it's possible to have established short positions right underneath this low. This one would have been a false signal, but this one would have not have, because it broke this low and it broke through dramatically to the downside after a rounding top. So even though it's not 100% perfect, it is a good way to determine the probability of future market direction when used in conjunction with the VIX. So let's take a look at the VIX, because before I really do anything in the market, I always take a look at the relationship between the VIX and current prices. When the VIX is relatively low, it's generally a clue that, in fact, prices in the stock market will begin to decline, sometimes decline rapidly. The VIX actually has a historic basis going back to 2003 for the VIX. Actually, the VXO was the original volatility index, which was based on the OEX index, and that goes back. Well, actually, I think it goes much farther back. Well, they started establishing data back in 2003. But actually, the VXO, the OEX Volatility Index, or the current VIX, goes back for quite a long time, but it looks like they didn't actually keep data on that. There's also the VXN, which is the Volatility Index for the NASDAQ. And you can see that when, now they just started to establish data back in 2001 for the NASDAQ Volatility Index. And you can see at what levels these were back during the market decline in 2001. Some of these volatility levels were as high as 80, 82, 83. They were extremely high. I mean, that's an unbelievable level. Since then, of course, we've had a tremendous rally, and prices have gradually started coming down on the VXN. But I take a look at the VXN and the VIX itself, which is the volatility index of the Chicago Board Options Exchange, to determine where the probability of prices will go. You can think of volatility in this way. When volatility is extremely low, people are very comfortable in their positions. They're very comfortable with stocks. They don't see the risk in holding stocks. They believe that everything is right with the world. Interest rates are low. Business is great. Stock prices are going up. And so they get complacent. And that's what happened back in December of 2007. There was actually a low. There was some volatility. Volatility index started moving up. They established another low. Volatility index moved up. But it never particularly broke this 12.5 level right here, which was a somewhat of a resistance point. Prices moved up again. The volatility index moved low. And right around the middle of February, all of a sudden, prices just fell apart and the volatility index increased dramatically. Now, when the volatility index increases dramatically in a single day like it did right here, it's generally a sign that volatility will continue to increase over time because of the large movement of the volatility index. And what it did was it did become extremely volatile. The prices went up, prices went down, prices went up, prices went down. Eventually, this resistance point for the volatility index became support. And prices on the stock market generally started to decline and get to the point where volatility was extremely high. Well, I wouldn't say extremely. They were high relative to its recent past. In order to determine really the kind of historical perspective that you need to use these long-term charts. You can see going back to 1998, 1999, and 2000, the volatility index was between anywhere from 1750 to 3750, and at times it had gotten up to the 55 level, in which there was extreme amount of fear in the markets. So what is the VIX anyway? Well, the VIX is really a sentiment indicator and of investor bearishness or bullishness. And it's an indicator based on the S&P 500. It's actually the statistical. It's a measurement of the volatility of the S&P 500, the implied volatility of the S&P 500. So what it really measures is how bearish or bullish people are on the S&P 500, and it's pretty much of a sentiment indicator. In other words, when people are feeling really good about stocks, it's very low. When people are very bearish about stocks, it's very, very high. And when you measure, when you take a look at the volatility, the VIX itself, you can almost determine whether or not things are going to get better or going to get worse in the market, and you can predict short-term price movements in the market with some degree of regularity, just based on the type of technical analysis we already do on stocks. So in other words, resistance points work very well on the VIX. Flags work very well. You've noticed that I've drawn a couple of lines here which are flags, which indicate, see, from this point here, volatility has started to decrease. It broke through this resistance point, which actually was a support line here. It broke through. It created a gradual increasing of prices here. See, the thing about flags is that they're not dramatic. They're not dramatically increasing of prices after a price decline like this. It's a gradual increasing of price. That's an important distinction to make for flags. But it established a flag here, so what happens? Well, we know that on the establishment of a flag, a gradual increase in prices after a severe decrease like this, that it's likely to continue that trend. The probability is that it will continue that trend, and that's exactly what happened. Here again, we had a small little flag. These three little bars is a flag, which is a continuation of the prior trend. So in other words, when we see these three little graduation in prices here, we know that the trend will probably continue, and it did. Again, we had another gradual increase in prices here of the VIX. So that is another sign that it will probably reverse itself and continue this downtrend, which it did again. Again, we have another little flag, decrease in prices. Then we had a pretty strong reversal. We actually had a resistance point here, a support point for the VIX that went back for a little while here. It went all the way back here to October 8th, where, remember, I talked about resistance and support points. This support point right here was significant because prices rose dramatically after touching it. So that's it becomes a support point at that point because of the way prices react to it. Well, it turns out to be support again here, and when that support was hit, prices reversed dramatically and started going back up again, which means the prices of the stock market decline. So when we were doing our analysis, let's separate this window here for a second, so I can show you this side by side. We're going to take a look at the Dow Jones as this VIX was unraveling here, and I'll do the let me do the 3-month chart on here, and I'll do the 3-month chart on here. So we're looking at the same time frame. Right here, when it bounced off of support, that was on May, between the 18th and the 19th. Let's just take a look here. That was the 16th, and that was the 19th. So it was a Friday and a Monday. Let's see where the Dow Jones Industrial Average was on the 16th and the 19th. There's the 16th, right here, and that's the 19th. The 19th is the exact day that it bounced off of that support point. At that point, we could have determined that, in fact, lower prices were coming in the market, because it had touched that support point and closed above it. And that's exactly what happened to the volatility index from that point forward. So in other words, I use the volatility index as a confirmation of what I'm looking at in the markets. I see a flag pattern beginning to develop here. I see the volatility index coming down into a support point. And those two events, this flag pattern being developed, also there was a resistance point here that was extremely significant because prices declined from it. So I've got that on the price, I've got that on the VIX. To say that there's a high probability that prices were going to decline at this point is an understatement. It was extremely high probability that prices were going to decline dramatically from that point, and they did. Here we have this little flag here on prices. Here we have a little flag here on the VIX. Prices continue to go up. However, we meet this resistance point here. There's a little resistance point right here that was established here, and it was established again here. And then here on this particular day, which is this day right here, where this little tiny thin candlestick was here, it closed below that particular resistance point. Now this resistance point, let me just take a look a little bit far back, because this resistance point was not the first time it was hit. It was hit here. It was resistance here. It was somewhat of resistance here, but the more times, remember, the more times a particular price is formed as resistance, the more significant it becomes. And what happened was, when this price right here closed below that resistance line, then there was an extremely high probability that, in fact, the market was going to rally sharply. And that's what formed my opinion for a daily review that I did on, let's see, it was June 5th, and actually I had formed the opinion on June 4th that the market would rally sharply. On the morning of June 5th, I established a long call position and created a three-legged box during this time period here, during this up rally, because there was a high probability that, in fact, the market was going to rally at this point. So the volatility index, in conjunction with patterns that you can see, support and resistance, and flag patterns that you can see, continuation patterns in the market, really form a very, very strong package to be able to not predict prices, but determine the probability that a price will move in a certain direction. And that's all I'm trying to get across. Is that support and resistance points are extremely important. Identifying continuation patterns such as a flag is very, very important. And then using that information in conjunction with the volatility index, the VIX, specifically, to determine the probability of future price movements. At this point right here, once you have a large bar like that, you have to kind of wait a day or two to determine whether or not there's going to be a continuation pattern forming. So at this point, let's say this is today's market, and for me it is, but you may be watching this video in the future. So at this point, I would wait, because it's a large bar. I would wait for prices to decline slightly. If prices do not decline slightly but continue the up pattern, I would expect that it would probably once again come back down to the 16 level and test this support point. If not, if prices begin to gradually form an uptrend, just like they have here, they gradually formed an uptrend before continuing lower. They gradually formed an uptrend before continuing lower. They gradually formed an uptrend before continuing lower. Then if we had a gradually forming uptrend before, then I would feel very comfortable in the fact that the market, as far as the Dow Jones Industrial Average and the other major industries, would probably continue on its upward trend. So we'd have to see two things. We'd have to see a gradual increase in prices on the VIX going up this way. We'd have to see a gradual decreasing of prices down this way for the Dow Jones Industrial Average before the trend would actually start to continue again. As long as the prices do not break these lows here, if we have a slow gradual decline in prices here, and as long as they do not break this low, in fact, let me draw my oval in here, because this is becoming a significant low here and a significant support level. Then we should be able to continue the upward trend, at least for the time being, and maybe get back up to this resistance point again. So right now it looks like there's support down here in this level. There's resistance up here, and we're kind of in this trading range. But the two of these together actually make a very firm foundation for any type of at least trading on a swing period, maybe 1 to 3 day period that you want to trade in. They're also excellent for looking at establishing iron condor positions, because once you have a very large up move like this, and possibly tomorrow if we have another very large up move, at that point it is an excellent time in which to establish an iron condor, because you'll probably get something similar to this, a gradual decline of prices after a very large upward price movement. Prices need time to consolidate after these large price movements. And those are good times to establish iron condors, because you know the prices are probably not going to move significantly for at least the next week. And during that week's time, you could generate some significant returns with iron condors. And you can also generate other types of returns using theta positive trades. And during the week that we establish our monthly trades, it's always good to know, it's always good if you have one of these large up bars or large down bars before establishing your positions, because you'll have a greater chance of sideward price movement, at least in the initial stages of establishing your monthly trade positions. So this is a very dynamic way of providing some sort of probability analysis to future price movement. The combination of actually taking a look at price movement as well as taking a look at the volatility index. Using this type of method of establishing some probabilities, you're not going to be fooled very often. I mean, every once in a while, you're going to get a flag like this where the prices just drop right through it. But once you realize that they've hit some sort of support level here and they bounce off of it, you can again, feel confident in the fact that the uptrend will continue. So these flag patterns are extremely important to be able to identify them on the fly as you're looking at different charts. And I would go through a number of different charts to take a look and see if you can actually establish these types of flag patterns, and you can tell when they're resistance or when they're continuation patterns, or when they're going to possibly fail like this. But realize that they will fail occasionally, like they did in this flag pattern, but you still had a lower you had higher lows here on this pattern, so there's a high probability that this pattern of higher trends and higher prices would continue. There's lots of material out there that you can read in addition to what I've just told you about continuation patterns. And there are so many different patterns that you can actually, look at charts and try to determine. There's triangles, there are, wide range bar technical analysis type of patterns, and there's about 1 billion patterns. There's like rectangles, and there's all kinds of patterns that people have tried to establish over the years as being more predictive of prices and continuation movements than others. But the flags work really, really well for me. And they make psychological sense too, because when prices are dramatically higher in a single day like this, it makes sense that prices are going to consolidate over a few days in order to, for people who got in early on this uptrend here to begin taking profits. And others who are looking to establish long positions, but additional sellers come into the market. So there's some psychological underpinnings for the reasons why these flag formations do form. But all I know is that they work pretty well over the course of any indice, or if you're trying to establish any type of position in any stock or ETF, they seem to show up in just about every single chart that you look at. In fact, I've gotten so used to using the Dow Jones Industrial Average or the S&P 500 index in conjunction with the VIX, I would never trade without it. I would never establish any kind of position in an index or an ETF without taking a look at both the VIX and the index itself in this way, by looking at flags, by looking at support and resistance points. It's just become second nature to me. And I hope it does for you. And it will become, I think, a habit for you if you begin to look at chart patterns. Take a look at a number of different chart patterns and begin to draw these flags and support and resistance points. And I think it's going to dramatically improve your confidence and your ability to enter into high probability trades in the future. Okay, let's continue here with something a little along a different line. I've showed you the technical analysis that I do on indexes or stocks by identifying flag patterns as well as support and resistance points. Another interesting thing about the stock market is that it will fixate itself at some time upon news events, and that fixation will continue for sometimes a long period of time. And I'm talking about weeks, months, in the year. But it is cyclical, though. So, for example, back during this time of the stock market decline back here, the news was reacting, and the market was reacting to news about the credit crisis, about the mortgage crisis, loans that were going bad in the mortgage industry. A number of financial institutions that were holding these mortgages could not price them, and there was a great deal of news about the credit crunch, the credit crisis that was happening in the United States, and actually it affected some parts of Europe and the UK as well. But every time a news item came out that was negative about the credit crisis or about in this time period, the market reacted negatively and would go down on the news. So, combined with the, if you can anticipate what the news is going to say about particular events, you can kind of get a head start on, in inputting that news or that correlation to the news into the pricing of the the index that you're looking at, is particularly the Dow Jones Industrial Average or the S&P 500 or something like that. So, if you start to see that there's some correlation between prices in the market and a particular news item, perk up your ears a little bit, because that is going to be the key phrase or the key word for probably several weeks or several months even. Anytime something negative happens in the credit crunch or in these mortgages that were written with no money down mortgages and all these other underwriting tactics that people and brokers had used during the late I guess it was going back to late 1990s and early 2006. And now they're coming out that many of these mortgages have gone bad. People aren't repaying the mortgages anymore. As soon as you started hearing about that, you could have, and the market reacted to negative news on that, it was beginning to develop a correlation to that news item. And the market would go down just based on the negative news that would come out about that item. Lately, if we go back over here, lately, these downturns in the market, let me just kind of focus in on this a little bit. And we're talking about June of 2008. And you may be watching these videos in the future, so the correlation is going to be completely different. But if you catch the news and you understand that the market reacts to the news, you can begin to develop, plug this into the system, the technical analysis system of support and resistance and flags that I've already given you. Now, at this time in history, oil prices have gone up dramatically from about $70 a barrel last August to now it's at this point it was about $135 a barrel, and that's high or low depending on what time frame you're listening to this. But my point is that when oil started going up, there was a correlation with the stock market to oil. When oil started going up, the stock market would go down on that. At least that was the justification for it for going down. Whether or not that's actually true or not, I have no idea, but the market does tend to fixate on a particular news item for quite a while. In this case, the market fell pretty dramatically here, about 250 points on this day. This was May 7th. At that time, oil had gone up, and they used the fact that oil had gone up for the market's decline. So there was a beginning of a fixation on oil prices at this time, and a correlation to stock prices. Again, the market kind of rallied up when oil backed off a little bit. Oil went up again, and the market sold off. Oil started to actually recede from those 135 levels down to about 122, and that's the same time that the market had actually started creeping up here in this flag pattern. And then, of course, oil began to increase. And today, the market is down currently 274 points on the news that oil had gone up $7.50 per barrel. So as soon as that, once the correlation is established between the market and a particular news event, it tends to stay that way for some time. Now, you can determine when the correlation is broken by the fact that, let's say a few days from now, oil goes up another dollar, but the market doesn't react to that. Or it goes up $5, and all of a sudden the market starts, instead of going down, it's doing the exact opposite. It goes up or something like that. Then you realize at some point in the future, that correlation will be broken. And another correlation, another news item. That's why you have to kind of, perk your ears up and kind of listen for the news and see, okay, the market went down or the market went up based on such and such. All of a sudden, there's a new correlation in the market. And it's just not negative news items that sends the market down. It's also positive news items that sends the market up. For example, if there's a trend of higher productivity, higher GDP, less jobs claims, unemployment claims, or less there's a greater number of new jobs being created or something like that along those lines, then all of a sudden there's a correlation with economic news, positive economic news, and those tend to send the stock market higher. So if you know that there's potential for the market to move higher based on your technical analysis that we've done, and there's a jobs report or there's a GDP number coming out, you can sometimes get ahead of that news and plan your trades a little bit further in advance. So that's a very interesting correlation. There's a correlation with the news. Now, I mean, after what's interesting is after this decline in the market and the credit crunch, I think the bottom was down. Let's see, where was it? Maybe it was down in here. That the Bear Stearns debacle happened, so the market really sold off on that. But then it recovered and went back up again. So that seemed to be like maybe it was back in here someplace, but that seems to be like the that was kind of like the climax of the correlation right there. That was like the high point of the whole credit crunch was the Bear Stearns takeover by J.P. Morgan, and the stocks, the shares of the stock, were like, decimated. They were just like down to almost nothing. It was like $2 a share, and it was really bad. So, those kind of news events are catastrophic, and if you know that is probably the end of all the bad news that's coming out, there might be more bad news coming out, but generally that was the biggest of all the bad news items that came out. And at that point, if you took a look at this chart, if you took a look at the VIX, you may have seen some sort of momentum building for a rally to the upside, especially now that that news is out. So keep, if you're interested in, plugging that into the formula, using your technical analysis, using your support and resistance points, and then keeping an eye on the news just to see what the market actually is reacting to, or at least perceived to be reacting to. It does help in helping you time your entrances into the market, especially when we get into Module 11, when we actually go into individual stock picks. So that's something to keep an eye on. It's very, very interesting, and it happens throughout. It's happened for years and years, at least 20 years since I've been following the market. There's always some justification or some reason why the market is going down, and a correlation is established, a relationship is established. Here, during this down period, it was the credit crunch. Now, to this down period, it's oil. Who knows what it's going to be in another couple months, but they'll always fixate on something. Okay, let's delve a little bit deeper into technical analysis as far as indicators go. I'm not a big fan of moving averages. I'll be honest with you. Price has its place. If you use the majority of indicators, in other words, that are being used by a lot of traders, have to do with the manipulation of price. You have, moving averages. I do have one moving average, and this is the only moving average that I use, and that's the 200-day moving average. I don't find it particularly helpful, except to kind of determine the very, very long-term trends. On a weekly chart, the 200 period moving average is way below the current market. On a daily chart, we're below the 200-day moving average. So, I think it has some. It kind of gives you a general idea of the trend, but you can see that, the trend was going up here, and even though the market was falling, the moving average was still rising. It didn't top out until the market had bottomed, and then it started going down. So it's a real lagging indicator. I think price in general is not the best indicator, or not only that, but it's not the best method of determining the highest probability future movements of the market. And the reason for that is that price is really just it's kind of a picture of the current state of the market, but it has no value to help you determine what the probability of future prices are going to be. The reason for that, I think, is prices just don't, they move up and down based on what people are buying and selling and feeling comfortable with the level at which they're buying and selling. But what we really need to do is take a look at both volume and one other indicator that is not smooth. The problem I have with smoothed indicators like this MACD down here, I do have the MACD up, but to tell you the truth, I don't even look at it. The MACD is simply a moving average convergence divergence. That's MACD, moving average convergence divergence. They use two different, or actually there's a center line and then there's two moving averages, and they take the difference of the two moving averages to determine some sort of trend line. And to tell you the truth, I don't even look at it. I've got it down here, but it doesn't really, I really don't look at it that much. All these indicators, stochastics, MACD, just about any of the studies that you can bring up, in here there are a huge, there's lots of stuff you can do. You can do the 200-day moving average, 50-day moving average. They have something called Bollinger Bands, which, at times may be helpful because Bollinger Bands basically just kind of give you what the standard deviation moves of a market is. So this is, they would put on the lower line is maybe one standard deviation to the downside. The higher bands is one standard deviation to the upside. Maybe it's two standard deviations. I don't know how I've got this set up here, but generally what will happen is, you can make a determination. Well, okay, it's very, very close to the standard to the upside, and then these things can be helpful. I put up different patterns and studies, but to be honest with you, I don't really rely on them at all because they're lagging indicators. They really don't. They don't help me determine what the potential or the probabilities of future prices are going to be. Let me clear these out. So I don't generally use them. I use two other indicators that are not really indicators, but actually what they are, they're measuring the internal strength of the market. And I have found these to be much more useful than any other tool I have ever used. These two tools include the majority, the breadth, which is the number of advancing and declining issues in the New York Stock Exchange, as well as the difference in the up volume and down volume of the New York Stock Exchange. And I'll bring these two charts up for you in just a second. But I want you to take a look at the raw numbers of what these indicators look like. I've got both down volume and up volume in my indices list here. I've also got the declining number of issues and the advancing number of issues. And if you just take a look at these numbers, it's very hard to determine any type of trend when you have these kind of numbers. So you have, but these are the symbols that you would use in the TOS platform in order to access these numbers. It's DVAL, UVAL, DECN, ADVN. This is the advancing issues of the New York Stock Exchange. That's the raw number. There's 643 issues up on the day so far. This is the declining number of issues for the New York Stock Exchange. There are 2,412 issues declining today. This is the volume in which these advancing issues have so far generated on the day. So this up volume is the total volume of all of these 647 issues that are advancing. And the down volume is the total volume for all of these declining issues. And when we chart these, what I do is I chart the difference between the up volume and the down volume and the advancing versus the declining issues, and you get something like this. This is the volume. The volume is on the top. Usually I put it on the bottom. And the number of issues that are either declining or advancing are on the top here. And it's very interesting because, for example, sometimes I'll sit here and I'll look at this and I'll notice that, in fact, let me go to this same chart because I use 5-minute charts on these. Let me just go down to a 5-minute chart. I'll bring these back up. For example, there was a rally here right around 1230. Now, the Dow Industrials averages right now are down 287 points. And right here there was a rally right around 1225. Well, at 1225 down here, that's where the rally started. Now, how would you determine whether or not that was a real rally or just a fake rally, a rally within this really bearish day that we're having? Well, one thing that I used is the fact that, okay, well, yeah, there was a surge in number of issues advancing on the day rather than declining, but you can see they started out at a very low level, and they started to advance here. Well, what happened to volume? Because this measures the amount of volume, the raw number of volume to the upside versus the downside. And the way that you enter this into the charts is simply $UVOL minus $DVOL. All this does is it charts the difference between the up volume that I showed you over here. This is the volume that all of these stocks advancing are generating on the day versus the volume on the declining issues. So these are the number of stocks declining at this moment, and that's their volume just for those declining issues. And generally what happens when you have a rally of any kind, you want to see where the money goes. Where's the money headed? Because when you track volume, in addition to price, in addition to the number of advancing or declining issues, money is really what talks on Wall Street. I mean, that is, money flow is just about everything. So we had a huge advance in the number of issues here that were actually starting to turn around and go higher. We had a slight surge in prices down here, right in this level. But what happened? Well, we didn't get such a big surge in the volume. The volume was extremely light on this increase in the number of issues. Let's also go over to one of my favorite indicators here, because sometimes I have these three all at the same time going up. I call this the happy family. my happy family charting technique. Basically, you can think of price as like the child of the family, because it's really erratic sometimes. Sometimes it'll go up, sometimes it'll go down. It's not very smooth. I mean, it just kind of bounces all over the place. And that's what children do, especially small children. They just bounce all over the place. They don't have any rhyme or rhythm. They don't have any plan. They just kind of, they just go up and down. The number of advancing and declining issues is the mother of the family. She's a little bit more stable than the children, but she still is erratic at times. I am sorry to all the women out there. Just, in general, they tend to be a little bit more emotional. But the father is the volume, and he's a little bit more steady. And you can see that even though the advancing issues and the declining issues tend to move around quite a bit, and so does price, volume tends to be fairly steady. So when volume says, hey, look, there's an advance here, but the volume is not going up considerably, then you have a divergence. So, for example, let's say you saw this price increase around $12.25. You saw the price is starting to increase here. Would you trust that price? Would you trust the fact that prices are headed up? Well, if you looked at the number of advancing and declining issues here, yeah, it did follow up. We had a huge number of, a huge increase here at the same time. It was right around 1225. A huge number of issues were advancing rather than declining. So that's a good sign. You've got prices increasing, and you've got more advancing issues rather than declining issues in this chart. However, when you looked at volume barely moved. In other words, none of the big money, none of the insiders on Wall Street were following this move at all. There was hardly any volume into this movement. So it was pretty sure, you could say with a high degree of probability that the downward momentum would continue because of the lack of volume here on this advance. So this would be a very poor time in order to go long. If you were day trading, which I do not recommend, however, if you were day trading, if you had these three indicators up, you would see that, hey, prices are starting to stabilize in here, and they're starting to go up little by little. Every single time there's a higher low, a higher low. You got three higher lows here. You've got a breakout here, actually. If you drew a trend line right across the top of these, you've got a breakout right here at 1245. And at 1245 here, oh boy, you're right up here. You've also had a breakout. For those who are into traditional technical analysis. And all a breakout means is that the previous high, I didn't draw the line right, but it's in that area. This high was taken out and advanced the price. Well, if we came down to volume here, you can see that the previous high was over here, and that was not taken out. So there was a divergence between these indicators. And that would, in most cases, what you want to do is simply follow the money. You can think of this indicator of the difference between the volume on the issues that are going up and the volume on the issues going down as really the money flow. In other words, if when this is going down, is money flowing out of stocks or into stocks? Is there more selling pressure or is there buying pressure? And in this case, since the beginning of the day, there's been more selling pressure than buying pressure. And when you follow this all the way down, there was a little bit of buying coming in here, but it was fairly weak. What you'd like to see on the volume is a huge green bar here that might indicate that, in fact, prices are going up dramatically, and there's lots of volume going into that move. Because you want to follow the money. You always want to follow the money in these types of markets. So the money obviously was going to the downside. There's lots of selling pressure in the market, and the market has dropped dramatically. I mean, it's gone down here from, we're 12,600 all the way down to 12,300. So there's a tremendous amount of selling pressure here. Now, if you looked at price alone, you wouldn't really be able to determine the fact that there was a very smooth amount of selling going on in the market on a 5-minute by minute basis here. But if you looked at this indicator, you could see that it was a very, very steady increasing in pressure, selling pressure throughout the day so far. Now that may change, who knows, but you can see that this divergence here, I mean, if you chased this increase in price, which is right around here, and you thought that maybe prices were stabilizing and going higher, and you went long, you would have been very disappointed because the volume did not confirm it, and prices actually started selling off from that point. So it will help prevent you from entering into positions that maybe if, let's say you're doing a three-legged box like we've been doing this past week, and if you go into the daily reviews, if you're looking at this in the future, if you're going into the daily reviews, you'd want to access the daily review for June 5th, 2008 to learn more about the three-legged box. So in any case, when you're putting on a three-legged box, what you want to try to do is get into a position on the long side, either calls or puts, early enough so that you can actually lock in your profits on that trade. And we did it twice this week, in which we only had to wait about 15-20 minutes on each trade to lock in our profits. And then at that point, it doesn't matter what the market does, you have your profits locked in, and actually you have a potential for an unlimited profit on the other side of the trade. So this is what I call the happy family indicator. And whether you like that name or not, that's okay. You can name it whatever you want. These are the children, that's the mom, and that's the dad. And if they don't all agree with each other, then you've got a very unhappy family. So this one, in fact, the father did not agree with this move up. And the mother moved up, and the children moved up. But the father said, hold it, guys. This may not be such a good idea. In fact, the market did go down again after that. So this is how I use this indicator. I put all of these three up together, and it's very easy to do. Let me just close these out. I'll show you from just about any window here. Well, you have to use, in order to do this, you have to use the charts that come with the Thinkorswim platform. And if you're using another platform, you could probably use those charts as well. But all you have to do is detach. This is a window detachment button up here in the right-hand corner. Just click on that, and then you can size it to whatever you want, and then you simply type in the symbols. Make sure you include the minus sign, hit enter, and it will automatically give you those numbers. I use the 5-minute chart. You can use the 15-minute chart if you like. You can see that the selling pressure has been extremely steady on the 5-minute on the 15-minute chart. You cannot use the daily chart though, because it'll give you this, and it's not a particularly attractive graph. This is really for short-term trading, and that's why I use the 5-minute chart. If you're really, if you're really into it, if you're really into day trading or something else like that, I think you'll find this to be a much better indicator, because almost every indicator that you could possibly use is a lagging indicator. In other words, they measure price and then they go backwards to average that price in order to come up with the number for their indicator. These are indicators in real time, based on market internals, current market internals. So there's no smoothing going on with these indicators. Oops. And that's all you have to do, is you just enter that, and you just enter the symbols. This is the advancing issues. It's $ADVN $DECN. Hit enter, and those charts will pop right up for you. So in other words, I mean, if you're not used to technical analysis, if you have no idea what technical analysis is, that's fine, because you don't need to know formulas. You don't need to know what the you don't need to know what stochastics are. If you go to the profit chart, if you go under studies, you can go to, I mean, there are just thousands of different studies that you can actually, go into. There's, accelerator bands, advanced decline line ratios, advancing declining issues, which is a good one. That's actually the one I'm kind of using, but a little different form. There's average true range. There's balance of market power. There's Bollinger Bands, EMA and SMA. There's CCI with breakout signals. There's correlation. There's cumulative volume index. You can go on and on and on. There's tricks and tricks 2. There's time series forecast. There's Fibonacci numbers. There's Williams accumulation distribution. I've used just about all of these. RSI, which is a pretty popular one. Stochastics, slow stochastics, fast stochastics. I can't even say it. Stochastics. There's just a ton of different, oscillators, and there's a parabolic stop and reversals. There's pivot points. I mean, there's just a ton of them in here that you could possibly use, but to tell you the truth, they are all just a variation and a smoothing of existing price movements for the most part. Some of them take volume into consideration, but for the most part, they just try to smooth out trends so you can try to find the trends. But I find them almost totally useless. That's just my opinion. I mean, if you're successful with one or more of those types of studies and indicators, that's fine. I like to keep it simple. I like price. I like the number of advancing and declining issues, and I like the volume, the difference between the advancing and the declining volume, because they're all real-time indicators, and when they confirm each other, then it really sets you up for a price trend change. And then you can do something like the three-legged box. You could put the call position on if you think this is going to turn around and start going up. You could, if the market was up and you felt it was going to go down, then you could put on a put position, wait a while, wait till the market starts moving in your direction, lock in your profits, lock the box, and walk away from it. So, it's an easy way for me to trade. It's an easy way for me to determine the probability, the potential for a market to move in a certain direction without having to rely on lagging indicators or smoothing indicators like the ones that are included in most packages. And I think that's where a lot of traders kind of get wrong. I've seen traders with 3 or 4 or 5 different indicators up on their screens all at the same time. And you could do that. You could go into studies here, and let's say we scroll down here into let's go into a standard deviation channel, and then we could put on a And we could go do a shooting star indicator, and then we could add a maybe some Bollinger Bands, and then we could add some alpha studies. Let's go to Alpha Jensen study here. And then we could add something else. Pretty soon, let's go into some momentum studies like CCI. Then we could add something else here. We go into a moving average, or let's go into some trend studies like the Arun indicator. Pretty soon you got a chart that looks like that, and I'm sorry, but it just doesn't make sense to me. It just doesn't make sense. But anyway, I mean, you can just. I just tend to use the simplest charting method possible. Just these three alone is all I really need to determine trend. Now, as you can see, we tried a little rally here again. We tried a little rally here. Volume did not cooperate. I didn't see, there's no big bar, there's no big green bar here indicating that people are starting to buy up shares like crazy. So this market is not ready to bottom out yet. It looks like there's still a good deal of selling pressure going on. As long as the difference between up volume and down volume is increasing, that means there's increasing selling pressure coming into the market. And it hasn't ended yet. It's a very steady decline. There's more selling pressure coming into the market, and that means prices are probably going to head a little bit lower here. Once we see a large green bar, if we see a large green bar in here, well, then maybe it could be the beginning of a new trend upward in the market, and the market could start to turn around. But, until we see that, then we don't really take any action. That's it for these three. I call this the Happy Family indicator because they're all real time. The last indicator I'm going to show you, which I actually have up here, but I didn't show you how to do this. I take the NASDAQ QQQs ETFs, and I take the QIDs. Now the QIDs, let me just show you what both of these ETFs are. These are two ETFs. The QQQs is the indicator, is the PowerShares Exchange traded fund for the NASDAQ. In other words, it reflects the prices of the NASDAQ 100 in an ETF. The NASDAQ 100 is a very interesting indicator because a lot of small players, a lot of people in the technology industry use that and like to buy and sell this index. And so it's more reflective, I think, of not professional money, but more of of individuals. And the QID is just the opposite of the QQQ. The QID is actually a ProShares ultra short of the QQQs. In other words, it acts in completely opposite direction of the QQQs. When the market's going up, the QIDs will go down. Like you can see today, that actually the QIDs are up for the day because the market is down. It's up $1.57 here. And the reason they do that is because sometimes it's very hard to sell short the NASDAQ 100. So instead of using the NASDAQ itself, so instead of shorting the QQQs, they provided this ETF that allows you to just buy this if you think the market is going down. Very similar to the VIX in the fact that it correlates negatively with the market in general. So in other words, when this one's going up, the market is going down. When this is going down, the market is going up. And what I've done is, all I did was I set up my chart here by taking the QQQQ, that's a symbol, the four Qs, minus sign, the QID. And the goal of this type of indicator is to simply measure the enthusiasm, disappointment, or of the participants who are trading the Qs and the QIDs. So in other words, what I get is a emotional indicator, a sentiment indicator, by taking the difference between these two. In other words, my reasoning is that when people are buying the QQQs, you're going to see prices spike up. Because what will happen is people will ignore the QIDs. They will buy the QQQs if they think the market is going up. When people are buying the QID, prices will decline rapidly, and it's an emotional buying. Then they will ignore the QQQs. They will go ahead and buy the QIDs as a substitute from shorting the market. Because people feel, in general, they feel more comfortable actually buying something rather than selling it short. To some people, selling stock short is considered to be extremely dangerous or something like that. It's not, but they feel that there's more risk in selling something short, so they wouldn't short the QID. They would actually go out and buy, they wouldn't short the QQQs. They would go out and buy the QID rather than short the QQQs. And so it kind of gives me an emotional indicator of what people, and remember, since this is on the NASDAQ, it kind of gives me a general feeling for the emotional state of the market. Now you can see the way I have this set up is that I trade and I follow the overnight sessions. The overnight session is in this light blue area right here. And right around, I guess it was about 8:30 this morning, trading started opening up around 7:30, I guess, this morning. And it does every morning. But it started going up a little bit. There was a little bit of enthusiasm here. It looks like things were really positive, especially after the day we had the day before. We went up 217 points on the Dow. But then all of a sudden, when some negative news came out, wow, look at that down bar right there. Look at that down bar. Those really long red bars are an indicator of emotional pain. And that emotional pain is translated into prices. And it kind of sets the tone for the rest of the day. When you see those large red bars like that, you get a feeling that people are extremely nervous. They're nervous about prices declining, so they're selling. They're actually buying the QID in this case because that's what we're tracking. If you had, in order to track each one of these different symbols, the QQQs and the QIDs, you'd have to have two different charts open. But because the TOS charts allow you to do pair trading in this window, I can put both the QQQs and the QIDs on the same chart and then measure the buying and selling pressure of those indexes, of those ETFs. So when I see a long bar like that, I had a feeling that the market was going to sell off dramatically today. And in fact, even if you hadn't gotten into a position early on in here, you could have waited till the market open. It did trade up for about 10 minutes before going back down, and you could have established a short position at that time and profited from this move down. It happens with some fair regularity. For example, here again overnight, this was on June 5th, 2008. This is the trading day for June 5th, 2008, in which the Dow Jones Industrial Average was up 217 points. Well, you could see in the overnight trading that there was quite a nice movement up here, and then there was a sharp downward movement, but it didn't really get much traction. There's no extreme large green bars or red bars in here, but it did pop up right at the beginning of the trading session. You didn't have a long bar there because it opened up already very high. If you had connected these dots, you would have seen an extremely large green bar here. But because the buy orders were already entered before the market opened, it just simply opened at this level, much, much higher than this is a huge gap in the prices. So people were buying the QQQs on the open here. If you knew that, you would have had a chance in the first 5 minutes or so to establish a long position on this long red bar, or at least waited until this green bar. But you would have been able to establish a long position, and that's exactly what I did when I did my three-legged box for that day on June 5th. I established a long position here and then rode it up until about here and then locked in my profits using the three-legged box and locking the box. And then, it did go up a little bit higher, but at least I got my profits locked in at that point. So this is a pretty good indicator for kind of determining what market direction is going to be in the pre-market before the market actually opens. And it does kind of give you an opportunity to establish some positions prior to the actual large up move. Like here again, it sold off a little bit, but then it started coming back up again, and it just followed that trend. When you get some erratic, you can get some erratic movement like this, but when it starts to trade down, there's no large bars in here, so it's not as predictive. It's not as helpful when it comes to predicting movement in the overnight session for the day. You really want to see those large bars. When you see those large bars, boy, that's a great opportunity to either go long or go short. Here's a good example here. Here, the market opened up in the pre-market. This is pre-market opening trading, and we had this huge green bar here. Now, we did have a little bit of a selling off just before the market opened, but you know what? If you had seen this long green bar and you had a gap open here as soon as trading started, you could have been looking at that point for a position to open on the upside. You had about 5 or 10 minutes here to establish a long position. If the internals, see, I use this in conjunction with these two charts. So in other words, if I saw the open very strong, the number of advancing issues was very, very strong, the volume was extremely strong, then I would go in and take a look at where I could establish a long position in here and just ride this one up. So that's how I use this. I use them all three in conjunction with each other. I make sure that both volume, first price, and the number of advancing and declining issues are agreeing with each other, and then I bring volume into the mix, and if volume confirms and they all three agree with each other, then there's a high probability. Now remember, we can never predict price. You can never predict price. You have no idea what's going to happen. But it gives you a high probability environment in which to take either a long or a short position. So those are my three main indicators, and I think you're going to find these to be extremely helpful for your short-term trading. I use these also when trying to establish either an iron condor. Sometimes I use them for my calendar trades, for my money every month trades, because what it'll do is it'll give me an idea if there's a lot of selling pressure coming in the market. I'll wait till prices kind of stabilize before initiating my iron condor or my calendar spreads, because when the market is extremely volatile, you may end up paying a much higher price for those spreads. And I don't want to pay a higher price. I want to pay a good price. I want to pay a fair price. And if I'm collecting premium, I certainly want to collect as much premium as I possibly can in a stable environment. So that's how I use those, and they have been absolutely terrific indicators for me. And those are the only indicators that I use. Besides, besides the support and resistance points. There isn't really very much. There isn't very much that's complicated about my system at all, but it's extremely effective. Looking for flags, identifying those support and resistance points, and I mean you could see here on today's trading, we came down to this resistance point that I had established here, going all the way back through here, and actually it was this little. It was this little point right here that helped me, and this little point here that helped me establish this resistance line. And now it looks like we've traded down to it, and it's bounced back up a little bit during the day. So we'll see if that holds, but it could be a significant resistance support point for the market. But more often than not, support and resistance and identifying flag patterns definitely work more often than they don't work. So you know what, if it would be in your best interest to study these videos again, go over the very simple types of technical analysis that I do. It's very simple. Once you get used to doing support and resistance points, identifying flags, and then using volume and the advanced decline, the difference between the advancing and declining issues and the difference between the up volume and the down volume. You're using real-time indicators based on market internals. Price, I don't trust. Price is not, to me, price is not trustworthy. I can look at a price and I can say, oh, it looks strong, it looks weak. I have no idea. That's why I say you can never predict price. I mean, you could take a look at the VIX, and that might give you that adding the VIX to your arsenal just increased your odds of success by about 90%, because the VIX will give you a very, very clear sentiment on what market participants are focusing on. If they're focusing on fear or if they're focusing on stability. And so just adding just looking at the VIX in addition to your stock charts is going to add a huge amount of confidence to your trading. And then when you get proficient, go ahead and add the other indicators, the up volume and the down volume, because you'll find that using those in conjunction with the VIX is going to be a tremendous help to your trading. Like I said, we can never predict price, but what we can do is give us the highest probability events possible in order to determine what the probability of future market direction is going to be. And with that, I will leave you. If you have any questions, don't be afraid to email me. Don't feel like you're bothering me or anything, because I really like to talk about this stuff and I'm really into it. So all you have to do is send me an email, and I would love to discuss this with you. I'm not saying this is the only way to trade. I'm not saying this is the only thing that you need to do in order to be successful, but it is definitely something that I think you should look at and add to your trading arsenal, because it's based on real-time movement in the markets. It's not based on any lagging indicators. So I tend to trust it more, especially the volume indicator that I showed you. So with that, I wish you all the best and trade with confidence.